All right, welcome to the Explainer. Today we are diving deep into what is, without a doubt, one of the most critical things you can look at when analyzing a bank's health. It's asset quality. And by the end of this, you're going to have a complete toolkit to analyze it like a total pro.
And you really can't overstate how important this is. I mean, the source material says it perfectly. Poor asset quality can just destroy shareholder value faster than pretty much anything else. But, the flip side is true too. If you understand this stuff, it can help you spot some incredible investment opportunities. So, let's get you geared up.
Okay, so here's our game plan for the next few minutes. We're going to equip you to see what other investors might miss. We'll start with why bank health even matters. Then, we'll get into the nitty-gritty of decoding bad loans, what we call NPAs. After that, we'll look at how a bank defends itself. Then, and this is the fun part, we'll learn how to spot trouble before it becomes a big deal. And finally, we'll wrap it all up with your own personal investor action plan.
All right, let's jump right in with the very first tool for your kid. We're talking about decoding the #1 symptom of poor health in a bank. These are the infamous bad loans, or as you'll hear them called, non-performing assets, NPAs. Getting a handle on this is absolutely fundamental.
So, what exactly is an NPA? Well, it's actually pretty simple. It's just a loan where the borrower has stopped paying. They've missed their scheduled payments, either the principal or the interest, for 90 days or more. That 90-day mark is the magic number. Once a loan crosses that line, alarm bells go off and it gets officially tagged as non-performing.
A loan doesn't just wake up one day and decide to be bad. It's a journey, a downward slide. It starts as a standard asset. Everything's fine. But the stage you, as an investor, need to watch like a hawk is the next one, the Special Mention Account, or SMA. This is your canary in the coal mine. It's the official watch list for loans that are just starting to miss payments. If they don't get fixed or cured at this stage, they start that slide down to substandard, then doubtful, and finally they're written off as a loss.
So, how can you actually, grade a bank's loan book? Well, it all comes down to two really powerful ratios. First, you've got the gross NPA ratio. That's the total pile of all bad loans. Then you've got the net NPA ratio. That's what's left after you subtract the bank's own rainy day fund, its provisions. And this cable, this is your cheat sheet. It gives you the exact benchmarks the pros use. For gross NPAs, anything under 1.5% is excellent. For net NPAs, if you see a number below 0.5%, wow, you're probably looking at a very, very solid bank.
Okay, so we know how to spot the problem, but what does a bank do about it? How does it protect itself? Well, that brings us right to our next tool, measuring the bank's defenses, or its safety buffer. In the industry, they call this provisions. It's actually a really simple idea. Provisions are just money that the bank deliberately sets aside to cover the losses it expects from those bad loans we just talked about. I want you to think of it like a financial shock absorber for a car. The bigger and better the shock absorbers, the smoother the ride, right? Same thing here. The more provisions a bank has, the better it can handle those hits to its loan book without shaking the whole company. Now, here's where it gets really interesting. Not all provisions are created equal, because not all loans carry the same risk. And regulators know this. Just look at the difference here. If a secured loan, say a loan with a house as collateral, goes bad, the bank has to set aside 15%. But an unsecured loan, like credit card debt, whoa, that jumps to 25% right away. And look further down. Once a loan becomes doubtful, that unsecured loan needs a 100% provision, basically writing it all off. It just goes to show you how much riskier unsecured lending really is. So how do we wrap all this up into one single, easy-to-understand number? Well, we use something called the Provision Coverage Ratio, or PCR. It's a simple but honestly super powerful calculation. It just asks one simple question. Of all the bad loans on our books, what percentage have we already covered with cash we've set aside? That's it. And if there's one number I want you to walk away with today, it's this one: 80%. A PCR above 80% is the gold standard. It's the benchmark for a really well-run conservative bank. If you see a bank with a PCR over 80%, it tells you they have a massive safety net for their existing bad loans. And for an investor, that is a beautiful thing to see. Okay, so we've covered bad loans,
and we've covered the defenses against them. But what if? What if you could see the trouble brewing before a loan is ever officially called bad? I mean, that's where the real pros make their money, and that's exactly what we're going to cover next. This is your early warning radar. This is the secret sauce for many analysts: days past due, or DPD analysis. This is all about laser focusing on those loans that are late on payments, but are still inside that 1 to 90-day window we talked about earlier, those special mention accounts. Seriously, monitoring this bucket is like having a weather radar for financial storms. It shows you exactly where the pressure is building up long before the storm actually hits, and this chart just shows it perfectly. Look, in a healthy bank, the vast majority of loans, maybe 95%, are totally fine. They're standard. The official NPAs might look tiny, just 0.5%. The gold is in those little slivers in between, the SMA 0, 1, and 2 accounts. The key question you have to ask is this: is that total SMA bucket getting bigger quarter after quarter? Because if it is, that's your flashing red light that future NPAs are cooking. So what specifically should you be looking for in the bank's reports? Here's your DPD checklist. First, track the trend in accounts that are even 1 day past due. That shows you the overall payment discipline of the customer base. Then, watch for any sudden jump in the 30-plus day bucket. That's an early stress indicator. And critically, monitor what's called the migration rate. How many of these SMA accounts are actually turning into full-blown NPAs? That tells you everything about how good the bank's collection team is. Okay, we have officially built the toolkit. You have the concepts, you have the metrics. Now it's time to put it all to work. This final section is your investor action plan. It's all about turning this knowledge into clear, confident decisions. So what are the absolute drop-everything red flags? These are your tripwires. First, a sudden spike in NPAs. If the gross NPA ratio jumps more than 0.5% in a single quarter, that's a huge warning sign. Second, that provision coverage ratio we love so much. If it drops below that 70% comfort zone, it means the bank's safety net is getting weaker. And finally, look for fresh slippage. That's the value of new loans going bad each quarter. If that number starts creeping above 2% of the total loan book, it might mean the bank's been too reckless with its lending.
And here's how you can bring it all together into a simple quarterly game plan. Step 1, every quarter calculate the core metrics yourself: GNPA, net NPA, and PCR. Step 2, never look at them in a vacuum. Compare them to the bank's direct competitors. Context is everything. Step 3, actually read or listen to what management is saying. Are they on top of things, or are they making excuses? Step 4, dig into the details. See which loan segments, like personal loans or corporate loans, are causing the stress. Step 5, this one's critical. Stress test it. Ask, what if things get even worse? And finally, step 6, based on all of that, update your own investment thesis. Is this still a bank you believe in?
So here's the bottom line. You now have the exact toolkit that professional bank analysts use every single day. You can look right past the noisy headlines and see the real foundation of any bank you're looking at. So the only question left is the one right here. Is your bank built to last? Or now that you know what to look for, can you start to see the first cracks appearing?